All right, so we've got a bit of a quiet start to trading this morning, but the markets have been sending a message that overall we are in a bull market, and we saw the TSX yesterday close at a new record. The S&P 500 has had upwards of 40-plus record stories to talk about already this year. And when you're at all-time highs, it invites all sorts of questions, especially when there's some economic uncertainty. But even on Wall Street, we've seen some strategists, BMO among them, that have raised their expectations for how much more the S&P can climb for here. Let's talk to our next guest about what he sees ahead and the kinds of areas he's watching closely in the market. David Burrows, one of our longtime guests here on BNN Bloomberg, President and Chief Investment Strategist at Barometer Capital Management. Nice to see you.
Great to see you.
What would you say to people who are looking at all-time highs and thinking, well, it's hard to keep going up when you're already at the top?
Right. Well, there's a lot of things. I mean, first of all, just to be clear, for a stock to go from 50 to 100, every dollar is a new high. So you can't be afraid of new highs. What we really care about is we look under the surface of the market to understand market health. And in the most basic terms, a healthy market over time should see more and more stocks performing well. If you went back to June, 24% of companies in the S&P were beating the index. That's one of the smallest numbers going back over many years.
When tech was all the rage?
Right. If you looked at it as of yesterday, 70% of companies in the S&P are ahead of the S&P index. So that tells you there's lots of stocks doing well. And if we look at from a sector to sector perspective, you know, tech has lagged. I think tech is up 5% since June. But there's sectors like the gold's up 23%. Regional banks are up 17%. Capital markets banks are up 15%. Industrials are up 10%. There's lots of sectors doing well. So in a healthy market, as long as breadth is expanding, you shouldn't be afraid, because there's no bear market ever happened while breadth was expanding.
I was thinking of this incredible season Shohei Ohtani's having right now. And while that is impressive as a single performance, it sounds like you're saying if everybody on the team has a pretty good average, there's a better chance that you're going to play well. Is that?
It's exactly right. And at the end of the day, we're all trying to build diversified portfolios. If to make an index type return, you got to be completely concentrated in a small number of stocks, that's risky. If you can have different characteristics in the portfolio and they're all contributing, right, that's really the right kind of market.
Okay, let's dig into diversification. Everybody's got an opinion of it. Sometimes the pundits will sort of lean into something for all sorts of reasons. It was lagging, you know, the economic backdrop or the interest rate backdrop would favor them. But I think there's a combination of short-term and long-term investors. How are you thinking about where to be positioned in the market?
Well, we very rarely look like an index. I mean, we do target and we do make have more concentrated positions in general. It's an interesting market right now because for a long time, the defensive sectors did very poorly. When the bond market was weak, utilities and REITs and telcos, pipes really underperformed. However, you know, at the same time, we were having pretty good performance out of financials and industrials, along with tech. Through the course of the summer, I think lots of people got concerned the Fed was being too tight and that it was going to cause economic damage. And so those defensive sectors really did very well over the course of the summer and have up until very recently. But we're into a cutting cycle. The Fed's 50 basis point cut gave other central banks the signal, okay to go with bigger cuts. And that's really lighting a fire right now under more economically sensitive groups, which I would argue probably have better risk reward longer term. And so, but there's an opportunity to be barbelled, get dividends and dividend growth, and then focus on some companies that are seeing upward earnings revisions. And industrials are seeing great earnings revisions. So materials are seeing great earnings revisions. So there's good opportunity there.
Okay, so industrials, materials, for anybody who listens to your commentary, that's pretty much in line with a thesis you've been building over the longer term. When I look at the TSX itself, you talked about the changing rate environment. I'm not going to single out real estate, but it is a notable return over the last 3 months. Like those stocks are up more than 20%. And you have seen financials, to your earlier point, utilities. They've done very well. So I guess I'll come back to that question. if something is all of a sudden jumping because there's a trend happening and people are unlocking value, that same thing about buying after the run-up, what would you think about for those really interest-sensitive specific stocks after they've already risen?
I think you have to be a little bit careful there.
Okay.
Because I do think that there have been a lot of investors and professional investors, big fund managers, trying to be defensive, and they saw those as the defensive places to be.
Yeah.
Earnings revisions in those areas are not that strong. So you shouldn't expect if the economy gets better, they're going to get a lot better. Now, utilities are maybe a little unique because there's a lot of hype right now about, this additional power we're going to need for data centers and the changes going on there. But real estate, if you look at residential real estate prices are trading at around 4% cap rates or returns on capital. Cost of capital is still like in the 6% range. So it's hard for them to go up a lot, but they'll pay their dividends.
Okay, so when I look at some of the stocks that you were prepared to talk about today, I see some of the names you've highlighted before, a few other ones too. There's a gold theme here. There is a financial theme like Manulife. Goldman Sachs is on here. In sticking with that industrial theme, Howmet Aerospace is on there as well. Pembina Pipeline. Just a number of different plays. We won't have time to talk about all of them, but anybody who's watching can jot some of that down for their consideration. But I guess I come back to this thing that I've heard a lot of guests say, which is if rates are coming down, then it gets more costly to keep cash on the sidelines or have stuff in GICs, which was one of the cases being made for getting into some of the rate-sensitive stocks. Do you see more money coming into the stock market because of that phenomenon? And would you say putting money to work in those kinds of names that I just highlighted makes more sense in your opinion?
Yeah, I think that there's a real opportunity here. So I talk a little bit esoteric.
Okay.
The U.S. dollar is seen as a place people go as a safe haven, okay? And when the U.S. dollar is going up, tends to be that stocks are under pressure, risk assets are under pressure. U.S. dollar is making new lows against the basket of world currencies. Canadian dollar's doing much better, Australian dollar's doing much better. That tends to be a time when people are willing to take more risk. So riskier assets are seeing flows out of defensive things like T-bills and US dollars into things that are perceived to have more risk. Global stocks are outperforming the US now on the year. The Canadian market, which acts more like global stocks, is outperforming the US market on the year. Industrials keep making new highs and their revisions are going higher. These are sector things that are not well owned. Everybody owns tech and they're great companies, but there's a credible alternative to being focused in tech. And so I think the risk reward favors industrial companies, it favors financial companies, it favors basic materials, which are basically hated. As of a month ago, commodities were the most short in funds than they had been since 2016, which was the worst part of the bear market for commodities. So there's good risk reward in these less crowded areas.
Okay.